The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk taxes. And I'm going to tell you, you're probably in the heat of it right now, wondering what the heck to do, and we want to help you. I'm Esther Gulius, the Tax Lady. I'm president of EG Tax Service. We have 30 area offices to serve you. We're open 9 to 5. On Saturdays. Our McKinley Mall office is open on Sunday during mall hours, and the rest of us are open 9 to 9 Monday through Friday and 9 to 5 on Saturday. So if you need the best tax help for the most reasonable fees, we certainly don't want to overcharge you. Give EG Tax a call or visit our website at egtax.com. Anyway, I'm Esther Gulius, the Tax Lady. I get Tiffany Fabian here in studio with me. Hey, Tiff.
Hey, it's so nice to see the sun outside.
It is. It's really, really nice. All right, today, and again, we want to, every week
nice
we
to
kind of
be
have a
outside.
topic, and today I thought I'd talk about things that you really need to pay attention to, little things that I've seen that are a problem with this year's filing. And again, if you have any questions, our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. Our toll-free number, our toll-free number is 1-800-616-9236. And if you want to text us, our text is 3930. So again, any way you want to give us a jingle, love to help you. Tiff, anything in particular you want to talk about?
I've been noticing this year a lot of people have they've taken advantage of the family leave credit, which is so exciting. Like a lot of my clients are having children, and the father gets to stay home and enjoy the company of his child. And then regrettably, one of my clients his wife had cancer, and so he got to stay with her while she was having treatment. And so the family leave is money that is taxable, and you're going to find it on a 1099 miscellaneous.
But here's the thing. It's so new. The 1099 forms that they're issuing, they're putting them in boxes that would make it subject to self-employment taxes, which is not the case. You should not make it subject to self-employment tax. So if your 1099 for the Family Leave Act says it's for non-employee compensation, that's wrong.
Right. So that would be found in box 7 where it should be.
And the
in
whole
box
thing is,
3.
when we tell you these things, and you say, I don't want to mess around with it. Believe me, you're going to mess around with it because they're going to send you a bill, and then you're going to have to mess around with it later. It's better to get it corrected today before the IRS gets you tomorrow.
Right.
Right?
Yep. And so and the worst part is if you put it on the self-employment line, you're going to pay self-employment
taxes,
which
right.
is really, really problematic. And so you want to pay attention
Well,
to
even
it.
if you think, it's just miscellaneous deductions, and you put it as miscellaneous deduction, if the 1099 is typed non-employee compensations, the IRS is going to bill you.
Right. Yep. And so
That's
you'd
why you
wanna
want to get it corrected. So this is the Family Leave Act. If you got a 1099 form, make sure that it doesn't say non-employee compensation.
Yep.
I saw one today. They put it under rental.
Oh, well. There you go.
Because they don't know what to do with
Section
it. But
8.
rental is better than non-employee compensation. I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. And I just have been so blessed by my clients. You know, the refunds are not so hot in many situations. And so to make people feel better, my clients have suggested that maybe I set a bar up in the back of the office to maybe have a happy hour before you start doing a tax return so they don't feel the pain. But the most important thing is what we want to do is help you so that the refund that you've become accustomed to, if that's what you want, we can help you to navigate that so that'll happen this year.
Yep, because it really is a difference. I've really discovered, unfortunately, married couples really are taking the brunt, and so they've lowered the corporate rate, and so...
Right, but single people are making out better than married couples because unfortunately, like for instance, on the change of the tax law, if you're a single person, you're limited to $10,000 SALT, the state and local income tax.
Right.
But if you're a married couple, you're still limited to the same 10. They didn't make it 20, they made it 10. So you're actually better off. And I know all of you ladies that are sitting with someone you want to be your fiance, and you've been telling them how much better taxes are filing jointly. Not really. I mean, and I am somebody that believes in marriage and the sanctity of marriage, but I'm going to tell you, as far as taxes go, after they did this tax reform, it's better to be single.
It's really bad. And somebody texted in, can we set up an appointment with specifically you, Esther? You are such a tax genius. I can't think of anybody as good as you. And so you would want to call 632-7.
And the only appointments I have left are 8:30 in the morning appointments.
Yeah.
I have not one appointment left except for 8:30 in the morning.
I'm up till April 13th.
Yeah, so we certainly want to help you. Our phone number, 8030930, 8030930, star 930 on your cell phone. Let's go to Mike, who's been waiting. Hi, Mike. How can we help you, sir?
Hi, Esther. I have a rental property, and I was thinking about replacing the windows. Is it possible to do a 1-year deduction on that, like a $179, instead of spreading it out with multiple-year depreciation?
It is absolutely possible, and what I'd suggest you do is maybe you want to call our office so we can talk about the cost of it, how many windows, and some of the safe harbor expensing that you can do now on property. They have really loosened up the depreciation on rental property, but just because it's deductible doesn't mean you'd necessarily want to do it, because it depends upon your income, whether you have income that would not allow you to take that whole loss. So you want to plan. So why don't you call us at the office, 632-7886, and we'll go over all the options with you, because it's too difficult to do right now.
I mean, a safe harbor has to be for something that has useful life of 20 years or less. And so this is a window that's 27 and a half years. So you can't use safe harbor, I don't think, but maybe bonus depreciation.
Maybe bonus depreciation would be 100%, like 179.
Okay.
Okay?
Very much.
All right, thanks, Mike. That's the whole thing. I was doing a farm yesterday, and he wanted me to expense everything, but he already was operating at such a loss. I said it doesn't make any sense that we are going to expense this, because you want to carry it forward because you already have a $22,000 loss.
And then not to mention the QBI this year, which is really nice. So the people who have a profit on their business budget.
Yeah, those of you that are self-employed, the qualified business income deduction of 20%, I just had one the other day, was $53,000 as an expense. I had one yesterday, $40,000. It's saving people a lot of money. If you don't know what it is and you're doing your own return, it can be daunting because you don't know what that means. It is a deduction that they came up with under tax reform, which is 20% of all qualified business income, and it's just an expense over and above your itemized or standard deduction. So again, if you need help with that, you can give us a call too. I'm Esther Gulias, the tax lady, 8030930, 8030930, star 930 on a cell phone, 3930 if you want to text us, and 1-800-616-9236. We're going to take a short break. We'll be back on the other side with your questions. Hey, I'm Esther Gulias, the tax lady. Frank, that sounds kind of like a game show intro, you know? Like this should be like Ask the Tax Lady. Anyway, it is Ask the Tax Lady.
It is.
Right, I'm Esther Gulias from EG Tax. We have 30 area offices to serve you, 9 to 9 Monday through Friday, 9 to 5 on Saturday, and Sunday our McKinley Mall office is open. Yeah. But you can text us anytime through our website. Email us through our website. At Ask the Tax Lady, and just ask your question, and you know that I answer you right away.
And another thing that I've been noticing is that the expanded child tax credit is really good for people. So that's a really good thing.
If you have children.
Yep.
If you have children. People without children, not so happy.
Right.
All right. But here's the thing. What I see this year is that people don't know how to read their brokerage statements. Mm-hmm. First of all, when you get your brokerage statement, the year-end statement is no good.
Right.
Because it isn't everything that you want the 1099 form that they provide you that will give you your interest earned, your dividends earned, and the stock sold, the brokerage fees, and it's a kind of a roadmap of deductions. And so the important thing is you should be able to look at your brokerage statement and understand what it is. So there's a section for interest if you are earning interest in your investments. There's a section for dividends. Now, dividends have ordinary dividends, qualified dividends, capital gains distributions, 1250 dividends, a return of capital, foreign taxes paid. Each one of those things saves you money, really.
Yep. Versus, short-term or long-term or
Right.
capital
So
gains.
when you have qualified dividends, people say to me, what's the difference between regular dividends and qualified dividends? Qualified dividends means it qualifies for special tax treatment. That means it saves you money. You get to use the Schedule D to compute the tax liability. Now let's say that you had $1,000 and you're in the 10% tax bracket. That would mean that when you go to the Schedule D, in effect, you would pay 0% on those qualified dividends, free. But if you don't go to the Schedule D to compute it, you're going to pay $100. Which would you rather pay, $0 or $100? Those are things that are found on your brokerage statement.
Right.
The other thing that's
I'll
on
take
there,
zero.
Pardon me,
I'll
I'd
take-
pay $0 for
I'll
sure.
take $0.
The other thing that's on there is something that's called a foreign tax credit. When you're in a municipal fund, that mutual fund that's buying and selling stocks, they have in foreign countries and in the United States, all different kind of stocks. Some of them are invested in foreign countries, and that charges the mutual fund taxes. They then pass that foreign tax onto you, and you paid it out of your portfolio. When it says there's a foreign tax of $80, that's a credit. You do a 1116, and you get a credit for that. So if you didn't know what the qualifying dividend was, and it was $1,000, and you had an $80 foreign tax credit, and you did it wrong, you have just overcharged yourself maybe $180. That to me is a lot of money, and in some cases it's far much more than that.
Right. It really is.
Then the other thing is, there's a section on there dealing with buying and selling of stock. I can't tell how many people think that they didn't sell stock. Well, I never even ask them anymore. I just go and do the Schedule D.
Right. You just get, because it's a combined brokerage statement generally, and it'll have interest and dividends, and it'll have a 1099-B, which will have the sale of stock. And so you just want to.
So just because you don't think you sold stock doesn't mean that you did sell stock.
Right.
If you don't put it on your tax return, what happens?
You're going to get a
Letter.
nastygram from
You're
the
going to get a letter
IRS.
from
Yeah.
the IRS. And if the stock sold for $10,000, they're going to just tax you on the $10,000.
Yeah.
So that's why you want to make sure that you're dealing with it properly.
And the brokerage statements are really confusing. They try to make them not so confusing. Like the sales, they code with this goes on as a coded A on the Schedule D. This is a coded B. This is an X. And so you want to make sure you pay attention to what the codes say.
But people don't know what the codes mean.
Right.
So if it's an A, it means it's a short-term capital gain. If it's an A, that means that they provided the basis to the IRS, so you know the buy and sell. You know exactly what the gain is.
Right.
Now, here's the thing. Many times, and by the way, I'm Estragilius, 8030930, 8030930, star 930 on a cell phone. Many times, and I catch this with my clients, there might be something that's coded in X.
Right.
So the broker doesn't know when you got it. He only knows what you sold it for. He doesn't know what the cost basis is. And yesterday or the day before, I said to somebody, you sold $10,000 worth of stock.
Right.
And there's no basis. Did someone give this to you? And they said, no, nothing's ever been
Right.
given to us. Well, your broker doesn't know. You must have given it to him later after you bought it, transferred it in. He doesn't know what your cost basis is. So if you don't find out, you're going to pay taxes on this whole $10,000.
They should go and find out.
That's exactly right.
Yeah.
So those are some of the things that you should be paying attention to when you're looking at your brokerage statement. And if you don't know how to read it, You're doing it. You're probably going to do your
Yeah.
tax return wrong.
And then I looked at somebody's brokerage statement yesterday, and they had no basis, but she had inherited it, and she knew the date that her mom had passed and the year, so she put that as her basis.
Well, and that's good. But again, if people don't know what they're doing, they can put the wrong figure down, which would cost them taxes.
Correct.
I'm Esther Gulias, the tax lady, 8030930. 8030930, star 930 on a cell phone. The other thing, another pet peeve of mine that I've seen this year is who should claim the education credit.
Right. And so a lot of young kids, they'll talk at school and they'll say, but I've heard
And they're
it's-
very good on computers.
Yep. And they said, well, I think it's better. I'm going to get a whole lot of money. But the truth is they don't have the portion of the education credit for liability. And so that liability part is off the table. And then the refundable portion, they're not entitled to unless
Well,
there's-
back up. Explain exactly how much is available on the American Opportunity Tax Credit.
It's a $2,500 credit. The first $1,500 is a non-refundable, and the last $1,000 is a refundable credit.
Right. So let's say that Junior has $8,000 in income. Mm-hmm. And so he goes to his little handy-dandy computer, and he does his own tax return, right?
Right.
So he's going to do the American Opportunity Tax Credit. How much of that is he going to get as a refundable feature?
He potentially could get $1,000. The software is going to ask if he provided more than 50% of his support,
And he's going to lie and say yes.
Right. He'll probably say lie, and so if he lies, he's going to get $1,000.
But if he doesn't lie, he'll get nothing.
Correct.
Because he's not going to pay any taxes anywhere. So Junior, if he says that he provides it to his own support, then he'll get $1,000. Now, what if the parents claim Junior, which they should do? Because you can claim your children that are full-time students past the age of 18 up to age 24 as long as you provide over 50% of their support no matter what income they make. As long as they're a full-time student.
Mom and dad would get $2,500, and then
And $400 on the state.
Yep, $400 in the state. If the education is really costly and they itemize, they can move the New York education credit to an itemized deduction. Yep.
And get even more.
And get even more.
So think about it this way. So your child gets $1,000, you get and the child is not going to get the $500 credit.
Right.
So the parents not only get $2,900 plus $500, the parents get $3,400. If the kid claims himself, the kid gets $1,000, and quite frankly, incorrectly.
That's another person who wins on the tax reform. Our dependent kids.
Right.
Yeah.
Right.
They win too.
So that would mean that if mom and dad said to Junior, I'll give you $1,000, we'll take what's left, mom and dad will end up with $2,400 extra.
Right. Yep.
So what to do? So if your child has already done his return and claimed himself, is there a remedy for people?
Yeah, you can amend their return, and take them off, and then do your return as a paper return. It would have to go paper with the dependent on it.
And so mom and dad would get the $2,400 extra. Mom and dad will get $34,000. The kid's going to owe $1,000, so they pay the bill for the kid. Mom and dad get the whole $34,000. So mom and dad come out $2,400 ahead. I mean, that is a lot of money. It's not $2,400 deduction. It is $2,400 real dollars.
Correct.
And I'm telling you, this happens all the time.
It really, 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 really does. And it makes you, so what I usually do is we bring in the child with the parent, and there's a form. It's an 8888, and you can actually allocate part of the refund for the mom to go into the kid's account and part of the refund to go in their account. And it's a really good idea.
So in case your kid doesn't trust you, because after all, you're just paying the lights, the gas, the house payment, you're giving them a car, paying for education and everything. But in case they don't trust you, you can allocate part of the refund to go back to them, and then the rest of it comes to you, so everybody's happy. But I'm going to tell you, this happens all the time.
Yep, it does. And so it really,
I just wish I could do all the kids everybody that's going to University of Buffalo, Buff State, Medina, everybody.
Not to mention-
could do all their tax
Hey,
return.
Not to mention, I was doing somebody's tax return the other day, and her child was 22 and claimed himself, and she qualifies for the earned income credit.
Right, but then she doesn't with the kid claiming it, right?
Right. It really broke my heart.
But you fixed it.
I'm fixing it.
Yeah.
They're coming in Monday.
Boy, I'm going to tell you. Anyway, if you have anything to say to me, 8030930, 8030930, star 930 on a cell phone. And are refunds being held up?
No,
No.
not at all. Which is really good to see. And
Yeah, the
federal,
federal whatever they did where they were shut down the government, partial shutdown of the government, has not affected people getting their refunds, so you don't have to worry about that. The other
New
thing
York State has
that's
been
another,
fine.
and then so I got another thing that's gone here. Let me
have
see.
you
Right
gotten
down
any
my-
letters from New York State from clients?
No.
Me neither. Which is very nice.
Yep.
Yeah, right now.
All right. So another thing is, don't assume you can't itemize. How many of my taxpayers have said to me, "I can't itemize this year," but that's not true.
Nope.
But I will tell you, because of the $10,000, and again, if you were two single people, you could both have a $10,000 SALT deduction, state and local income tax. If you're a married couple, it's still $10,000. So it's better to be single under tax reform, which kind of breaks my heart.
I'm going to send a letter to my congressman after tax season because it's just not fair.
It isn't. It's terrible. But anyway, don't assume you can't itemize. And anyway, we got our calls coming in. We're going to break for the news. We'll be back on the other side with your calls. I'm Esther Golias, the tax lady.
Hey now, you're an all-star. Get your game on, go play. Hey now, you're a rock star. Get the show on.
Hey, this is Esther Golias, the tax lady from EG Tax, and we're going to go right to the phones, and we're going to talk to Marie. Hey, Marie.
Hello, Esther.
What's happening?
I'm just questioning whether or not I have to file taxes. I've made just a little bit under $25,000 again.
Well, are you single or married?
I'm single, divorced,
How old are you, Marie?
77.
All right, so when you're talking about $25,000, is that including your Social Security?
Yes.
How much of that is Social Security?
I don't have that with me now, but most of it.
Well, what do you think? About 18,000? Well, so let me ask you this. Let me back it this way. Are you working?
No.
Do you have a pension?
No.
Where's the extra money coming from? Just interest and dividends?
Yes.
Okay. And so you have no withholding, right?
No withholding.
You don't have to file.
Okay, I didn't think so. I've been a customer of yours or a client of yours for 5 or more than that, probably, 10 years, and I haven't filed the last 2 for that reason, 25,000 or less, but then I wasn't sure.
No, you're good.
It's changed. Thank you.
Thanks, Marie. Bye-bye. Let's see. We're going to go to John in Buffalo. Hey, John.
Hi, Esther.
Hi. What can we do for you?
Well, I just wanted to get your thoughts. I'm a real estate agent,
Okay.
and I got hit pretty hard.
I bet you did,
Yeah, so
because it was a hot year in the real estate market. So you got a nice net profit, and you're paying large FICA and income taxes, right, John?
yes.
So now, why don't you put some money into an SEP?
Well, I need to get first through this.
Okay.
I owe, even though I had paid some quarterly, 2 quarterly payments equal to last year, which I was advised to do. I owe just over $2,000 to the state and $12,000 to
The federal.
IRS.
Okay. So here's a couple things you can do.
Yeah.
You can put what's your net profit? You know, John?
I don't.
You got a ballpark, 50,000, 80,000?
Probably
John-
around 50. Yeah.
John, did you
80,
deduct-
did you say, John?
I'm sorry.
What did you say your net was?
About 50.
All right, 50. So you can do 12,500 approximately into an SEP. So what is that going to save you? Are you married or single?
I'm single.
Okay, so if you do that it's going to save you about $3,000 in taxes, okay? Now, you can file an extension, and that'll extend the time to put the SEP make that SEP, but you get to take it as a deduction now. So you could file an extension, not file the paperwork until October the 15th, and then put your 12.5 into an SEP. That'll reduce your liability down to about 9. And are you also paying your own health insurance?
Well, that was part of it because I was it was kind of a crazy last couple of years, so I was subsidized.
So you're paying back your health insurance?
About $3,600, yeah.
Okay.
$300 a month.
Did you deduct your miles and office and home and
Yeah.
all your continuing education?
Wouldn't an IRA
Well, an IRA, how old are you?
I'm 56.
All right, so an IRA gets you $6,500, an SEP would get you $12,500. An IRA has to be funded by April the 15th. An SEP has to be funded by October the 15th. So it buys you 6 months.
Okay. So, all right, and I appreciate all your help. Thank you. So I just had a quick question. Would it make sense, because I am really nervous about this, would it just make sense to do a installment plan with the IRS?
Oh, of course. I mean, that paying the liability is the easy part. Getting to what your real liability is the part that I'm concerned about. Because for you to just lay down and say, well, this is what I owe, without trying to knock it down further, to me isn't prudent. You want to make sure that you get it down for as much as you possibly can. Those are some of the tools that we're talking about. So
So an IRA or a
SEP.
An SEP is going to let you put 25% of the net profit away. And also, did you do your QBI?
You guys do it for me, so I don't.
Oh, okay. Well, then our computers do it automatically. So that's what I would suggest. So if you think you want to set aside the 12.5, by the way, do you own a home?
I do.
Do you have equity?
Yes.
Have you thought about doing a home equity credit line and just paying off the liability and getting straight so your estimates can be correct and then you'll be all fine?
I didn't consider that, no.
So, I think you need to strategize. So if you want, you can email me through egtax.com, Ask the Tax Lady, and I can make some suggestions for you. But I would strategize. So I would pay the liability if I could. If you got the equity, I'd pay it. I'd get rid of it because you're only going to pay like 4.5%, and the IRS is going to charge you a lot more than that if you do an installment agreement. And then I would think about loading up my SEP with as much as I possibly could, and then you basically make that payment on April the 15th for your outstanding liability, which might be less than $9,000. Then you have till October the 15th to put the money into the SEP. That's just some of the strategies that might be available to you.
Okay, well, I thought the installment was only like 5%.
I know, but that's more than home equity, and you got to understand, it's 5%, but then there's a failure to pay penalty, and there's interest. So there's failure to pay and interest,
And a fee to set up the
and
installment.
a fee to set it up. And it's going to it's like a slow hemorrhage. It's just going to kind of come out a little at a time. If you can get rid of it or most of it, I think that would be a good thing.
All right.
Okay?
Appreciate your help.
Hey, we'll talk to you later.
Thanks.
John. Yeah?
Yeah.
Yeah. Okay, let's see. We're going to go to
Yes,
Steve
it
in
is
Buffalo. Hey, Steve.
very common.
How can we help you, sir?
Here's the situation. I went ahead, I bought a mutual fund back in March 2017. About a year later, that mutual fund went ahead and changed the share class on me. So they went ahead and they made a mandatory exchange.
Uh-huh.
And I'm using the terminology that they're using. And then shortly thereafter, I then went ahead and liquidated my position entirely in that mutual fund.
Mm-hmm.
Talking period of 13 months. Now, they went ahead and they gave me a cost basis for this fund in the long-term transactions for covered tax lots, but then they also had an entry here for undetermined term transactions for non-covered tax lots. And in that, they don't provide me a cost basis, nor do they go ahead and provide me with a date of purchase. And how am I supposed to take care
All
of
right, so if you just bought this in 2017,
Right.
that you should, I would call the broker, because under law they were supposed to keep track of the basis. Talk to your broker,
Right.
okay?
Yeah.
All right, thanks, Steve. Bye-bye. By the way, when they call it a non-covered basis, it means that that they don't know. They don't
Right.
know what you paid for it.
Yep.
What do we got on the?
It says I'm a real estate agent. The new 20% deduction comes directly off the top of my gross income.
No,
Correct?
no. This is how the QBI works. You do all of your income, your net profit, You get to your adjusted gross income, then your itemized deduction or standard deduction, then the QBI.
That's how it goes.
Okay, that's the way it goes.
recipe.
Okay, let's see. We got Bob. Hey, Bob. How can we help you, sir?
Hey, I have a 529 plan for my son, and I took money out to pay for his college expenses. But my son is not listed as a dependent on my taxes. He's listed on my ex-wife's taxes. So can I still take that out without, there's a penalty if you take it out without paying educational expenses. I think it's 30%. Can I take that out, and how do I claim that?
Sure. So there is, you have to pay tax on the earnings if you take it out. And you
But he's
also-
using it for his kids' education.
No, he said he wasn't. Then you have to add it back
No,
to the
you said
state.
you're using it for your kids' education, right, Bob?
Yes, I am using
Oh.
my son's education, but my son is not listed.
But his son is not listed as a dependent on his
Oh,
return.
Yeah, so you can list it and you can take it out. There's no penalty you, and you're fine. There's
Right.
nothing you have to do. You have to record it on your tax return, indicating how much the student's education was. And you couldn't take the education credit on the state, but you can anyways because you can't claim the child, so
Right.
you're good to go.
So it's not taxable as long as it was used for education. In the event that they ask you to prove that, it should be a piece of cake that
Right.
you used it for your son.
Can my ex-wife claim him as for the
How old is he?
community? He's 18.
Yeah,
She sure better.
And she's going to get the education credit on the federal,
But not
she,
on the
she
state.
won't get it on the state.
Necessarily. How much was the 529 deduction? Distribution.
Like $8,000.
How much was the school tuition?
$775.
All right, so you covered it, right?
Yep. So she
Okay,
can
so
take
just
the
on the federal.
credit on the federal,
But that's
not on the state.
$2,500.
Right.
And a $500 family credit she gets for him. So she's going to save $3,000.
And she can claim that even though she didn't pay for his education?
Yes, sir.
Yes, sir.
Yes?
Yep.
All right. Thank you much.
All right, thanks, Bob. So many people think that if the kid borrows the money, or if the kid pays for it, or if the grandparents pay, they can't take it, but that's not true. Or if they borrow the money.
If the man under the bridge paid for it, you could still take
Right,
off the college
absolutely.
credit.
I'm Esther Golias, the tax lady, 8030930, star 930 on a cell phone. What do we got?
Oh, I was going to have you do these first.
Okay,
but-
I'm going to talk to John. Hey, John, Mr. John, how can we help you, sir?
Good afternoon. My question is on my state tax with the exclusions. My wife and I are both over 65.
Uh-huh.
We have like 4 1099s. File state tax, even though the last 4 or 5 years, we haven't owed anything and nothing's changing on our.
Okay, you want to make sure that you're filing a federal return, right, John?
Yes.
Okay. So what happens is the federal government lets the state of New York know that, gee, John's got all this income from pensions. Now, the state of New York, without knowing that you qualify for the exclusion, could send you an inquiry or a bill. The best way to ensure, it's like buying an insurance policy, that they're not going to bother you is to submit that tax return with the federal income carried forward and your subtractions for your pensions, whether they be just regular pensions or government pensions, to let them know that these are qualified exclusions, subtractions, and you don't owe anything, and then you can sleep at night.
Oh, okay. My other question was, I stopped doing it because I used to get it. We have the long-term long-term care insurance, and I thought when I initially did it that I would get that money back as a refund.
No, it's a credit on the state, and it carries forward, but it's a non-refundable credit.
Yeah, I was very disappointed that I was.
Yep.
I said, I'll get at least a couple $100.
You know, they do that all the time. People selling stuff. You got to really, if it sounds too good to be true, you better double check it.
Yeah, but it's such a pain to fill out. I mean, you used to be able.
Well, but you don't have to do that credit form.
No, I'm talking on the 1099s now. Back to them.
Okay.
Information to enter. So we have. So I actually, between the pension and the four, I have 6 entries. So it's a lot of entries to make. And
Are you using software?
no, I do it by paper.
Oh, okay. Because I was saying if you do it by software, usually you enter it once and it comes right over to the state as an exclusion. Well, you know, John, it's your mail and it's your summer, and if you don't mind getting love letters from the state of New York, you don't have to do it. But to me, it'd be worth it this Sunday if it's cold and windy out and it's blowy. You just might want to do it to avoid the potential problem.
Well, the last thing is I think I need to do it to qualify for the
Your star, right.
Yeah, so I guess I answered my own question.
Okay, John. Well, see, I'm glad we solved that problem.
Or he could come in and I'll key him all in for him.
Yeah, like you got time. Okay, John, thanks for calling. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. And, okay, let's go. We're going to talk some more
Want
about...
me to go to the text?
Yeah,
for
go
you?
to the text.
Okay. If a Schedule CEZ is filed for a piano accompanied having no expenses, is her QBI just 20% of her earnings?
Yeah, if there's no expenses. Now, bear in mind, people don't get sucked into thinking, oh, well, if somebody makes $100,000, there's no expenses, and the QBI is going to be $20,000, that's good. But remember, if in fact you had expenses, let's say there were expenses of $10,000 that you aren't taking, it's true that the QBI would then be 20% of $90,000, which would be $18,000. But on the $10,000, you're saving 15.3% FICA plus income tax. So you're not going to beat the QBI is no way going to beat taking deductions. So don't just kid yourself into thinking I'm just not going to worry about it and I'm going to get this big deduction for QBI because you still have to pay on the FICA
Self-employment tax. Yep. And so you really want to.
Right. And then, kind of speaking of the people being self-employed, when you're self-employed, then the FICA that you pay, which is the full 15.3% just about, half of that FICA you pay is an adjustment to income. You get a subtraction for that. Mm-hmm. You also can reduce you get another subtraction for self-employed health insurance you pay.
Yep.
You also get a deduction if you want to put money into a simplified employee pension, 401k plan, or an IRA. So all of those things are subtractions before you even get to itemized deductions.
Yep, like you suggested with that guy, that real estate agent, and I thought that was a really good idea. The SEP, you can do an extension for the
which extends the time to make the money, put the money in. So really you can kind of use this year's sales to offset last year's income. So you, in his situation, $3,000 in tax savings, that's unbelievable, which brings me to the other thing I want to talk about. Again, 8030930, 8030930, star 930 on a cell phone is the IRA can be your best friend. So let's say you're doing your tax return and you find out you have a balance due, and you're thinking, oh my gosh, how did this happen? I'm going to go change my W-4 at work tomorrow. If you have no qualified pension plan, or you have a qualified plan but your spouse doesn't, you can be eligible to put up to $13,000 married filing a joint return if you're over the age of 50 or over, or $6,500 if you're single, or $5,500 if you're under age 50, into an IRA, and you can file the return now, save the money now, but make the contribution up till April the 15th, and you can possibly get the Retirement Savers Contribution Credit.
That's right.
Which is?
That's the Form 8880, and that's credit that you get for putting money into a SEP.
Right,
or
up to
retirement.
50% of what you put in.
Yep.
Mamma mia.
It's about the more you make, the more the credit is until you start making too much, and then it goes away eventually. So it's a really good credit. You can't be in college to qualify, but it's a great credit. It's a good tool in your toolbox.
All right, so the other thing I want to talk about is don't think that just because you may not be itemizing on the federal that you can't itemize on the state.
Or there's many, many, many people that are itemizing
On the federal, yeah.
Especially if you're single.
But people walk in and they say, I didn't know if I should bring my, but you should. Because, like for instance, now I had an over-the-road trucker this morning, and of course, his miscellaneous itemized deductions are gone on the federal. But on the state, we ended up with the same deduction that he had the year before. So, and he's out of town 260 days. So he had like a $10,000 deduction on New York State. And it's true, it only saved him $700. But
Right.
I would rather get $700 than leaving it to somebody else.
Yeah. Undeniably. Yeah.
Right.
Yep.
So again, the things that are deductible are your medical.
Union dues.
Well, your medical.
Right. Oh, you're talking about the federal.
Yeah.
I'm sorry.
State and local income taxes, real estate taxes, foreign tax
Miscellaneous.
credit, up to $10,000. Mortgage interest is deductible on your
Casualty.
primary mortgage and any and any home equity that's tied to the improvements or the acquisition of the house.
Correct.
Acquisition indebtedness. Charity.
Right.
Especially if you're somebody that's a tither and you're giving lots of money to church, for sure those people almost always itemize.
Yep.
What's gone is the miscellaneous itemized deduction. So the over-the-road trucker, the union dues, et cetera, you have to go to New York State to do that. So don't forget that. That's on, what is that? A New York 196, I think.
Yeah.
Right?
Something. Yeah. I think it is a 196.
All right. And then the other thing is, so your IRA can be your best friend. Claim your kids up to age 24 if they're full-time students.
Yep. Up to the age of 24, you get to claim your kids as long as they're a full-time student for at least half of the year. You
get the family credit of $500 plus their education credit.
Yep.
And if they've already been in school for 4 years, you would get the lifetime learning credit.
Yep, that's right.
Which is 20%.
Yep. There's a lot of people who are going on to graduate school, and they're getting a lot of student loans maybe, and so you have to make sure you tally the lifetime learning credit. You wouldn't qualify for the education credit on New York because New York is only the first 4 years.
That's exactly right.
Yeah.
So, but all of these things, and remember, a credit is money in your pocket. So if your kid is going to Yale and you're paying $30,000 and it's already after maybe he's doing graduate work, then you'd be limited to 20% of the first $10,000, which is $2,000. But it's $2,000 in your pocket.
Yep. And then, student loan interest, so that's $2,500, and you want to make sure that you take advantage of the student loan interest deduction if you pay student loans.
That's right. So, again, those are things that people forget. And then child tax credit. If you're paying somebody to babysit your child, or your disabled family member.
Yeah.
Like maybe grandma's living with you, and the only way for you to go to work is to have somebody come in and stay with grandma, and she's your dependent. Then the child care credit's available, federal and state. And on New York State, the child care credit is refundable.
Yeah, which is really nice. But in that same vein, you want to make sure you don't pay cash. You use checks, or the money comes out of your checking account, because New York State usually follows up on that huge refundable credit.
Right. And the other thing is, if you have, I have a client that has an adult disabled child. Mm-hmm. So the adult disabled child is living in her home, and she makes about $18,000 a year. So because the disabled child is 25, you would think that she wouldn't qualify for the earned income credit, but she does.
Yep.
Because a disabled child qualifies for the earned income credit. They have to be permanently and totally disabled. And so a lot of people think that once the kid gets a little older, you're not able to do that.
Yeah,
right?
I amended somebody's return who did this.
Right. Anyway, I'm Esther Gullius, the tax lady. Look, we really want to help you. Give EG Tax a call if you need any help. We'll answer your tax questions. Go to our website at egtax.com. I'm Esther Gullius with Tiffany Fabian. Until next week, have a great day. Bye-bye.